Subscribe now and press the bell icon. Never miss an update.
Hi guys! This video is about investment at cost, immediate consideration. Investment at cost represents the amount of money or cash or shares invested in the subsidiary. When the parent buys shares in the subsidiary, they could buy shares for cash or they could buy shares for a share exchange. Now this is considered as immediate consideration. And the investment at cost figure is extremely important because it's used in the goodwill calculation. So we need to know exactly how much money or shares was invested in the subsidiary and what is it worth. With immediate consideration, the standard says that we need to find the fair value of the amount promised to the subsidiary. Now, the parent can buy the shares either by giving them cash or then doing a share exchange. If you are giving the subsidiary cash, then it's simply put, the amount of your investment is going to be the value of the cash that you have given. However, if you are giving the subsidiary shares in return for their shares, this is known as a share exchange. I will give you some of my shares if you give me some of your shares, so let's do an exchange. And the value of this investment is simply the market value of the parent shares given to the subsidiary. So what you will do is find the market value and then the value of the parent share capital and share premium is going to be shown on the face of the balance sheet. Let's have a go at this very simple example with shares. Polo acquired 75% of Solo's 20 million ordinary shares on the 1st of April 14 by means of a share exchange of 2 new shares in Polo for every 5 shares acquired in Solo. The market value of Polo's shares at 1st of April 14 was $2 each, and Solo's $1.20. The par value for both companies is $1. The net assets at fair value at acquisition of Solo is 11 million. What is the goodwill on acquisition? Well, goodwill starts off with investment at cost. So we need to know what the investment value is since they have a share exchange. So what we need to do is find out, if I took X number of your shares, how many shares did I give back to you as part of the agreement? Well, first of all, how many shares did I take from you? We took 75% of the 20 million shares. That's 15 million. So we took 15 million of your shares. So how many shares did we give back? The question says that the parent will give 2 new shares for every 5 shares they took from Solo. So that is a ratio of 2/5. So for me to find out how many shares the parent has given up, that's simply put 2/5 times the number of shares we took from Solo. So 2/5 of 15 million, that's 6 million. So what is the market value of this 6 million shares? The market value of the parent 6 million shares is simply going to be the market value of the parent shares, which is $2 times the parent shares given up, 6 million. That's $12 million. That is the investment at cost. And then what we do, to find goodwill, we have to take the investment at cost and add on the NCI value. The NCI value is, if I bought 75% of the shares, that means 25% is the NCI. You take the NCI percentage, you multiply it by the subsidiary shares, 20 million. So therefore, that's going to be a quarter, that's 5 million. What was the market value of that 5 million shares? The market value of the subsidiary shares in the previous slide was $1.20. So that was 6,000. And then we take away the fair value of the subsidiary's net assets at acquisition. And this was given us to be 11 million. So if you add down this column, the goodwill at acquisition to be shown on the face of the balance sheet is 7,000. Now that is the answer to this example, but there is an additional step that we need to be aware of. The parent has issued extra shares to pay for the subsidiary shares. So when a company issues shares, this could affect their share capital and share premium. Remember, the market value of the parent shares is $2, whereas the par value is $1. So that means the parent has made a $1 premium on the shares that they have given up. So on the face of the balance sheet, you will have the cost of investment to be used for goodwill, 12,000. But in the parent's share capital and the parent share premium, you must reflect this 6 million share capital $1 and the 6 million share premium $1. Remember that on the consolidated statement of financial position, the share capital and the share premium balance is shown that of the parent only. So the original share capital and the original share premium must be added by 6,000 respectively. And that's how we deal with immediate consideration.